So it's a pleasure to be here. I'm going to talk a little bit about what I think some of the big issues are in the financial crisis, and hopefully leave lots of time for questions, because that's more interesting. If you disagree with things that I'm saying as I go along, or you have questions, just interrupt me. Nobody in my house lets me speak for very long. So, and certainly not my colleagues. So, sort of an outline of what happened. There are also questions about why is it so big, since a lot of the discussion surrounds the subprime market, which is fairly small, and then some issues about what we should do. Okay, so many factors encouraged the boom in the housing market, which is where this started. And I'm going to primarily focus on what happened in terms of finance. Okay, there are bigger issues going on in terms of savings, and this is some of the points I have up here, that their interest rates in the United States were low for a long period of time. Economic and population growth encouraged people to purchase houses. And government also subsidized and spurred people to purchase houses as well. So a lot of factors encouraged people to buy homes and buy bigger homes. Okay, this is a graph that I wish I would have had a few years ago when I bought the house in Providence. As you can see, the boom in housing really was extraordinary. Okay, and over the last, if you look from about 2000 onwards, this was an extraordinary acceleration in housing prices when looked at over a long time period. Okay, so when people talk about a housing boom, it really was a housing boom of historic proportions. Okay, the other thing that happened was that the funding of mortgages changed. Okay. And so I kind of have a little example, and it kind of harkens back to my love affair with the Flintstones. Okay, so you have, in the simple example, you kind of have Barney's bank, lends money to Wilma so that she can buy a house. And in return, she gives a mortgage to the bank, the mortgage simply being a promise that she's going to pay back what the bank gave her, plus some interest. Okay, and that was the end of the story. Okay, so if we looked at a balance sheet, basically what happened in terms of the assets of the bank is the bank had a promise that Wilma was going to pay her. Okay, and then the bank probably collected some deposits, and then there was some equity or capital, and this was sort of the way things worked for quite some time. Okay, let me just go through this. But there are problems with this. Okay? Okay, so the problem is that after Barney's bank makes the loan to Wilma, Barney's bank may not have any more money, or Barney's bank may not want to expose itself more to the housing market. Okay, so in that type of a situation, the bank might be sad, oops, if it doesn't have any more money. And Betty is sad because, then she can't go out and borrow to buy her own house. Okay? So this was sort of a situation that was ripe for, as we would kind of talk about it at Brown or in business, it's like, okay, we have a situation where there's a problem, and a problem oftentimes means that there's an opportunity for innovation. And that's exactly what financial markets did. They innovated. Okay? And what they did is they created, this thing, securitization, which is we can take a whole bunch of mortgages, we can stick them in a bag, we can call that bag a mortgage-backed security, and then we can sell the bag. Okay? Now the nice thing about that for Barney's bank is now Barney's bank has cash, and so it can make the loan to Betty. Okay? So this is really, quite a good innovation. Oops, I have my glass there. Okay? So this changes the balance sheet for Barney's bank. The mortgage, it's sold. It now has cash, and it's now ready to do what it does best, which is, or maybe what it does well, which is make mortgages, and then it can make the mortgage to Betty. Okay, so all is good. Okay, now this invention Okay, and it wasn't an invention. I mean, it existed before 1980, but the expanded use of this technique really changed how mortgages are financed. Okay, so I mean, this is not a small thing. It's like there's like a lot of blue, which means that the mortgages are on the books of Barney's bank. And then here there's a lot less blue, which means that the mortgages are not on the books of Barney's bank. Instead, they're sold as mortgage-backed securities. So somebody else holds the mortgages, not Barney's bank anymore. Okay, so this is a big transformation. Okay, so a big run-up in prices, big transformation in terms of how things are sold. Okay. Now, it also means that somebody had to buy the packages of mortgages from Barney's bank. Okay, so we kind of, I'm just going to use your table here. So there were a number of entities that did this. Okay, and we'll talk about some of the reasons why. First of all, the banks themselves frequently bought these bundles of securities that they themselves were selling. Okay, so we got to talk about why they would do that, and we will. Okay, but pension funds purchased them, foundations purchased them, the retirement, so these pension funds are both private, but they're also the state. They're, like teachers associations, professors, and others, insurance companies, hedge funds, many entities bought these bundles of promises, these mortgages, because they decided it was a good way for them to diversify their portfolio. And people bought them here, and they bought them abroad. Okay? So, Fannie Mae and Freddie Mac, okay, these are GSEs, the government-sponsored entities. So these were these things that at one time were sort of private, and the government said that we don't guarantee them. But then, as we know, when they got into trouble, the government guaranteed them and took them over. Okay, they helped this whole securitization process take place. Because basically they'd say, look, if you buy this bundle, we'll make sure you get your payments. Okay, so that made it much more appealing for people to buy the bundle. Okay? Okay, so another thing you can see is that the actual funding of mortgages, again, changed dramatically. I put these pictures up because it's easy to see that these are big changes. Okay, so this red stuff is that you basically had savings and loans, okay, and you had some credit unions and you had commercial banks. But if you take everything from here to here, okay, what you're talking about are commercial banks, savings and loans, and credit unions basically being the ultimate holders of our promises as homeowners to pay back. Okay? And then if you go forward 28 years, okay, that's a much, much, much smaller chunk of the pie. Okay, so the funding of this thing changed dramatically, and these are all basically one form or another. Those are these mortgage-backed securities, and they're either organized by the GSEs, Fannie Mae and Freddie Mac, or they were securitized by private entities, which means they didn't come with the government guarantee. Okay?
Are those totals 11.3 trillion, is that outstanding or?
11.3 trillion outstanding.
Outstanding.
Yeah, I'll give you actually in a little bit, there's another graph that'll sort of show you what the housing stock is composed of equity and debt. But yes, that's the debt part. I think it's about half is equity, which means it's about half of the financing of a home is equity in the United States as a whole, and the other, about another half is through mortgages. And that's not quite half. Okay. Now, securitization didn't happen only for mortgages. Okay, once we got into this, we got into this for everything. Okay, and I had some really good students, and they were talking about securitizing tax obligations. I mean, anything that didn't move too much, you kind of would securitize it, and student loans and car loans, even commercial loans. Okay, so this was big, trillions of dollars. Okay, the value of securitized assets of this form is bigger than all of the deposits in banks. Okay, so this became very big. Yeah, okay. Sorry about that. Okay, so then there were some effects of securitization. Okay, and part of the point I want to bring up, talking about Barney's banks and so-and-so is unhappy and so-and-so is that this invention in and of itself, I would not necessarily classify as a bad thing. Okay, this meant that people who would not otherwise be able to buy a mortgage could now borrow to buy a house because credit was less expensive because of this invention. Okay, and you had companies that were, yeah.
How does the securitization work?
So literally, basically what happens is if I'm a bank, let's say I'm a bank and I've lent money to all of you for homes. Okay, and so what I'll do is I'll take all of your mortgages. So it's a piece of paper. Okay, and the piece of paper says that you promise to pay me, a certain stream of payment for the next whatever. Okay, I take your piece of paper and I kind of get a bag and I stick it in a bag. I take all of your mortgages, I stick it in a bag, and then I go and I have somebody take a look at the mortgages in the bag, and they kind of rate it. They kind of say whether it's like this is a good bag or not such a good bag, and then they stand up and they say who wants to buy this bag, and then you have an auction and people buy the bag. And then there can be what can then happen after that. Can get more and more. You can get more and more complicated because then what would happen is entities would buy the bag, and then they would immediately borrow money from people to buy the bag. And those are these things, these collateralized, the collateralized debt obligations. So it can get increasingly complicated, but that's sort of the essence of securitization.
You would buy the bag expecting to make money off it?
Sure. So if I offered you, if I took all the mortgages in here and I offered you the bag, your question would be, how much is the bag? And you'd want to have some assessment of the risk. And either you would do the assessment of the risk, or if you felt you couldn't do the assessment of the risk, you might say, I don't want this bag because it's too complicated for me. Or if I told you that this government-sponsored entity, Fannie Mae and Freddie Mac, were guaranteeing the bag, you might be willing to pay quite a lot for the bag. In fact, you might be willing to pay for the bag as if it were a treasury security if you felt that this guarantee, were close to the guarantee of the treasury when it borrows. Or if it wasn't the government guaranteeing it, then you'd pay a correspondingly lower price. And this is a huge, big market, and so that's how this was set. Okay? I'll get a little bit in a second to, I'm not going to go toward the collateralized debt obligation part, but I am going to talk about why you would feel comfortable, or many people would feel comfortable about buying this bag, because they ultimately had to be rated. Okay? Actually, and that's going to be sort of my next point. Okay? So now, if you think of yourself, if I think of me, and there's this bag filled with 10,000 mortgages, okay? I'm okay at putting together PowerPoint presentations because they basically come prepackaged. I'm not going to be too good at figuring out exactly how good each of the mortgages are in this bag. Is it next to a flood zone? Are they all kind of next to something that might have an earthquake? So that are like this, there's sort of a high correlation in terms of if something bad happens, all of these mortgages are going to go bad, or are they well diversified around the country? I don't know, are they all exposed to termites? Or, what kind of jobs do they have? Do they all work for one company, for which all the people who have these mortgages for which there might be an international competitor? What's the quality of the assets that they themselves as homeowners had when they actually got this loan? Like, how good are these people in terms of credit risks? That could be kind of complicated to figure out. If there's an increase in interest rates, how exposed are these people that are promising to pay the mortgages and the stream of payments into this bag? How exposed are they all to interest rate risk? Okay, so this could be a very complicated thing. And luckily, what people did is they went to credit rating agencies whose job it was to sift through this bag and say, this is a AAA, or this is an A, or this is a B. Okay? And I'm sure many of you know the credit rating agencies and all of the letters and numbers better than I do. But in some sense, it's unimportant for the story, because all that matters is that the credit rating agencies put a certain stamp on this about their assessment of the risk of these securities. Okay? And investors tended to have a lot of faith in the credit rating agencies. Okay? Now, if you were going to put a lot of your money on the line, and I came up to you and said, don't worry, it's AAA. AAA is really good. Now, I don't know if you take my word for it or not. Okay? But you'd be wise not to. Okay? So you might not. Okay, so why were these credit rating agencies taken so seriously? Part of the reason the credit rating agencies were taken so seriously is that the Securities and Exchange Commission, the SEC, put its stamp of approval on the credit rating agencies. And many, many, many government entities, okay, including a variety of regulations on what municipalities, government pension funds could invest in, okay, those regulations basically said you can only invest in securities that are rated by the credit rating agencies, within some particular range. Okay? Excuse me?
Who paid them to do that?
Who paid the credit ratings agencies to do that?
Yeah.
Okay. So, this is okay. So the credit rating agencies historically dealt with this is a great question, because this is going to be sort of my theme of a lot of what was going on. Is that with the credit rating agencies, were typically what they did is they rated bonds. They've been doing this for a long time, 50 years, 100 years. Okay? So there's a problem, and that is that if I'm a buyer of the security, I want to know how good the company is in its credit rating. I want to know what its probability of default. Here's these people, okay, well-trained, and they're going to go out and they're going to assess it. Great. Now, if I pay them for their assessment, okay, the problem is if I pay them, I can turn around and take their information and sell it to you. Okay? So that means it's going to be very difficult for the credit rating agencies to make money. It's very expensive to assess a very complicated company. If you think of I don't know what your training is. It'd be very complicated for me to go and assess Exxon. Okay? It's kind of a mess. Credit rating agencies, no, not that there's anything wrong with Exxon, just because it'd be complicated, beyond my capabilities. The credit rating agencies are well trained, and they send teams of bright people. They go to Exxon, they do the assessment. Okay, but they may need, for that activity, they may legitimately need a payment of $1 million. Okay, now they can't sell it to me for $1 million. I don't even have $1 million. Okay, so what they would want to do is sell it to each of us for a certain fee, right? And then they would accumulate all of that, and then they'd get their $1 million. Okay, but then I go to them, I says, okay, here's my $100. Tell me the secrets of the temple. Okay, and then I can turn around to everybody else and sell it for less than $100. So the way it worked out was that Exxon would pay them. Okay, so then you get the situation where Exxon is paying the credit rating agencies to rate them. Okay, so you have the standard conflict of interest, but the credit rating agencies basically survive because of their reputation. Okay? If they don't do a good job, people are not going to believe them, and then the companies are not going to buy their services. Okay? So this worked okay. Yes, there were some conflicts of interest, but it sort of dealt with this problem of sort of potentially free riding. So this worked okay. Okay, so this is one of the themes, that you had regulations, you had credit rating agencies, they were overseen by the SEC. This worked sort of okay. Things are not perfect. Okay, now remember how big securitization is. Okay? Because before you had the credit rating agencies, which are basically saying, no, I'm not going to sell my soul for $1 million, because the entire future stream of profits of having this stellar reputation of being a sound evaluator of risk would go away. Okay? And so that's why it sort of worked okay. Now, okay, you take securitization and you add this to the table. Okay, now remember how big securitization was. Okay, we're talking trillions of dollars. Okay? So you might not be willing to sell your soul for $1 million. But $1 trillion is a different story. Okay? And the thing became very, very messy, and it harkens back. This is going to be another theme. It harkens back to what happened with the accounting firms. Because you said, who paid the credit rating agencies? One is they got paid for rating the bundles of securities. Okay? Then, as I mentioned before, sometimes you would take these bundles of securities, some entity would buy them, and then it would turn around and borrow in order to buy them. Okay? Because the entity that was buying them didn't want to have all of its capital on the line. Now, when it went out and borrowed, sometimes there are various types of ways in which it could borrow, all different sorts of promises that it could make in terms of borrowing in order to buy this thing. Okay? Now, if it could borrow securities that were rated AAA, people would buy more for those than if they're BBB. Okay? So, the entities that were buying the mortgage-backed securities would go to the credit rating agencies and they say, look, we want you to rate the stuff that we're going to sell to the public. And we want it to be rated really high so we get a lot of money. Okay? We'll tell you what. We will pay you to design it, how to borrow it. And then we'll pay you again to rate what you designed. Okay? So that's the answer. Okay? Okay. Okay. So this sort of then gets to your question was perfect. So your question, well, for me, I don't know. The question was perfect. You guys got to decide on the answer. So the issue here is that you had, there's a series of things where you have a good innovation, okay, and this interacts with a good old policy. Okay, and we'll talk about more policies as we go along, but the good old policy here has to do with a variety of official regulations that essentially sanctioned the credit rating agencies. Okay, those sanctions and the setup worked okay in the good old days. Okay, but once you added this innovation on, it didn't work so great after that. Okay, and we're going to see, I at least see this theme in a variety of ways. Okay, so what you have now is you set up a situation where lots of different players have very bad incentives. Okay, so the loan originators. So remember, the loan originator was originally Barney's bank. Okay, so the older days, Barney's bank, it makes a loan, and then Barney holds that mortgage. Okay, so if the mortgage doesn't pay, Barney doesn't get paid. Okay, so Barney has lots of incentives to really make sure that whoever it was, Wilma, is of sound credit and all that good stuff. Okay? Okay, but now you have the loan originators. Okay, what they want to do now is they make the loan. It's going to be like Countrywide. It's where I got my mortgage from. And then they're going to turn around and sell it. Okay? They don't really care whether I pay back, as long as somebody else thinks that I am going to pay back. Okay? Okay. Now this loan stuff, there's also behind the scenes here, okay, is public policy is really pushing government ownership. Okay, if you go to you get like, sort of an insomniac like I am. If you want to go to the Boston Fed, they have an interesting description that was written a few years ago about, encouraging. Okay, but when a Fed sort of encourages a bank, it's more than sort of, standing on the sidelines, cheering your daughter in a basketball game. When a Fed sort of encourages a bank that has like more impetus behind it, there's a set of policies there where it's sort of telling the banks, look, we want to encourage low-income families to own homes. For low-income families, a lot of your standard formula for computing their abilities to pay back the loan, they don't hold. Okay? So if you use your old standards, you're basically prejudicing credit allocation against those who are poor. Which might be true, but that doesn't necessarily mean it's a sound investment decision to do that. And so the document's really, it's quite remarkable from my perspective. Okay. Okay, then you have the managers of the entities purchasing the mortgage-backed securities. Okay, so for those of you who know more than, do kind of know a lot about this stuff, so it's whether it's buying the collateralized debt obligations or whether it's buying directly the mortgage-backed securities, I'm not kind of worrying about that too much for right here. Okay, but the issue is that, so you could think about this as, if we could kind of bring this close to home, we could say, we're talking about Brown's endowment. Okay, so the managers for Brown endowment, basically, they can't go and invest in ridiculously risky things. Okay? Of course not. So they have to be given guidance. Okay? Limits. Okay? At the same time, you want to give them incentives to make big returns. Okay? So that you could give professors big raises, of course. Okay? So, you have the standard thing. You want to give them incentives to make money, but not take on too much risk. Fair. So one of the things you might think of doing is saying, look, most of the stuff that you invest has to be AAA. Now within the category of AAA, there's sort of, maybe really risky AAA and not so risky AAA. But the not so risky AAA, that pays like a higher return. The risky AAA pays a higher return than the not so risky AAA. And basically, my contract says it pays a higher return. I get a percentage of the returns. It's AAA. Life is good. Okay? Now, this is, I kind of put it within Brown just because. But, this is really stark actually in insurance companies in Europe. Okay? They were giving very strict guidelines by their government in terms of what they could invest in. Okay? And those guidelines were not go out and do an assessment of the risk, they were invest a certain amount in AAA. Okay, so again, we come back to this credit rating. Okay, this becomes very, very important for what people invest in, whether it's like little towns in Australia, whether it's gigantic insurance companies in Europe, or whether it's a variety of things. Okay? What's interesting, okay? This is very interesting in terms of the story that we're telling, because so this is sort of this is sort of like the researcher in me. So if you have, what we're sort of, the point here is that if you take one money manager, okay, and let's say this money manager works for the insurance company in Europe, and this money manager is told, invest in AAA, okay, and you get a percentage of the returns. Okay, you expect that money manager to sort of buy the riskiest of the stuff within the class of AAAs. Okay, now you go to a hedge fund operator. Okay, and you take the money and she runs the hedge fund. Okay, she has a lot of her wealth on the line. She has a few clients who are kind of, very keen on assessing what she's doing. Okay, she doesn't have a guideline to just invest in AAA. She wants, good return based on the risk. Let's just say she goes out and buys a AAA security. Okay, if she's really doing her homework, I would expect that the delinquency rates today are less than the guy who's managing the insurance company, okay, who didn't care, who was just going for a return within the class of AAAs. And this is actually what you see today. Okay, you see very, very distinct differences.
How does the delinquency rate differ between people rating the AAA? Are there any discrepancies there?
Oh, among the credit rating agencies? I don't think so. It's a good question. It's a good question. I don't know the answer, but I haven't heard anything about that. Okay, I'm sure if there was a difference, that people knew of, I would hear about it. But people may not have looked at it yet. It's a very good question. Okay, so we got the credit rating agencies. We talked about them. Okay, bankers. Okay, now the bankers, they're like everybody else. They want to make money. Okay, now the bankers, they want to do a couple of things. Okay, so you have the regulators. This is going to be this other theme. You have the regulators. Banks are very heavily regulated. I don't know. I mean, I remember talking to people, and this is something, like, the Citibank, there's like 30 federal regulators in the bank every day. Okay, so this notion that like the banks are not regulated, they may not be properly regulated, but there's huge amount of regulation. I mean, and there's okay, so here, okay, so you're a bank, and there's this tension. There's this tension. So you have one of the big things in terms of regulation is you have capital requirements. Basically capital requirements is you tell the banks, hey, you go take some of your assets and put it in something safe, like stick it in the Fed where you get 0 interest. Okay, but it's pretty safe at the Fed, since if the Fed messes up, they can print more money. They do it electronically. It's too expensive to print up cash. Okay? So now the bankers don't like that, because if you tell a bank, okay, here you have assets and you have a choice. You can invest it in something that earns return, or you can stick it in the Fed. Okay, this is a no-brainer. Okay? So there's always going to be this tension where the bankers are frequently going to try to do things to reduce the amount of capital, which basically means reduce the amount of stuff that they have stuck in low return assets. Okay? Now, the regulators have the capital in order to give the banks incentives to not take on too much risk, because if they take on too much risk, then they'll lose money, and to also have some sort of a cushion. So here's sort of the thing with the securitization that was sort of very, very, very bizarre. I mentioned this earlier. So you had Barney's bank, has a bunch of mortgages. Okay? Now let's say these mortgages are rated AA, just because. Okay? So the mortgages are rated AA. AA means that the regulators look at it and say, aha, it's AA, not AAA, therefore you have to hold this much capital. Okay, and the banks want to hold less than this much capital. Okay? Okay. So the banks say, I got an idea. Why don't we take these mortgages and we'll securitize them? Okay? Now, we'll securitize them, we'll put them over here in this bundle. We'll go to the credit rating agencies, and the credit rating agencies will rate this bundle a AAA. And now, we'll buy that bundle. Okay? Now, I'm kind of exaggerating a little bit, but not a whole lot. Okay? Much less so than I wish I was. Okay? And then the regulators were looking at this, saying, it's AAA. Okay, they have to hold less capital. Okay, it's basically like holding Treasury securities. It's basically like holding the stuff at the Fed, because they're holding AAA securities. So now the banks can hold less and in kind of the Fed and earn more in terms of returns. Okay, the other thing that the banks did, now the point here is that you had regulations, okay, that said, hey, let's look at the assets. We'll partially use the regulator's own assessment of the risk, but we'll also use the credit rating agency's assessment of the risk in order to make sure that they have enough capital. This makes good sense. Okay? So this is like a good old rule. Good, like it was good. But then you get the invention of the mortgage-backed securities grow. You get the movement over there. And you get the same regulator saying, yep, AAA, less capital. Okay, there's a real problem in terms of not sort of using kind of a general vision of incentives here. You had credit default swaps. Okay, so basically the bank may have a certain exposure to the mortgage-backed securities. So remember, they bought the mortgage-backed securities over here. Sometimes there was a contractual obligation for them to kind of come and help out a little bit if those things got in trouble. Okay? The regulators would look at that and say, you have a contract here, okay, therefore you have to hold more capital. So the banks, it's actually JP Morgan, they went to AIG and they said, you know what? Have we got a great plan for you? Why don't you write an insurance contract? Now, it can't exactly be an insurance contract for regulatory reasons, and it's not quite defined in the same manner. We'll call it a credit default swap. And what happens is, if this security goes bad, the insurance company will pay the bank money. And that will insure the bank against the risk of that security. This is a great idea. Okay? This is a way to spread risk, because then AIG can turn around and kind of on the other side, kind of match its obligations, by kind of selling the kind of like the opposite insurance to other people. So it's really a brilliant innovation and very legitimate. Okay, but if you're the regulator, okay, it's your job to make sure, not your job, I don't want to accuse any of the regulators, it's the regulator's job to make sure that the bank has proper incentives. Proper incentives means that the equity holders have a sufficient amount of their wealth on the line. So this is this whole notion of capital requirements. So if the bank is saying, look, we have insurance, so that if we get into trouble, this money will come in, it would be sort of natural that the regulators would sort of say, well, who's giving you the insurance? And are they doing a lot of this? And what happens if there's sort of a general problem in the housing market? Are they going to be able to come through, when things go awry? Nah, forget that. Okay, I'm being a little bit facetious but that's a bad tendency that I have that I can't seem to break. Okay, but it sort of gets the point across, I hope. Okay, so the insurance companies, okay, so you had the guy Cassano, who ran the division in London for AIG. Okay, so he's selling these credit default swaps. So look at his incentives. Okay, so this general, what's the term? Like you eat what you kill. Okay, so the notion here is like, so insurance, you got this standard problem. It's like, okay, I sell this insurance contract to the banks. That means I get money today. Okay? The insurance contract may go bad tomorrow. Okay? But I earned a lot of profits for AIG today. And therefore, I should get my bonus today. And then if AIG goes bad tomorrow, the stockholder should take care of that. Okay? And so this was sort of potentially a problem between the sort of the owners, maybe not having the ability to monitor, what was going on. Okay, so for the past econ majors, the standard agency problem. Okay? Okay, so so there was this problem of the incentives that were distorted by potentially a really wonderful innovation, and this kind of interacted with regulators and regulations and laws that didn't adapt. So whether you want to call that deregulation, not enough regulation, I get nervous about that because that's a very encompassing term. And my own way I'd like to phrase it is that there was an innovation that really distorted people's incentives. And any basic common sense within the context of the existing regulatory regime would have adapted to these new innovations. Okay, subprime. Okay? Now, once something gets rolling, like they used up the whole prime market. should I just like stop? I'm not sure where I am in terms of time. So you just, if it starts to go long, just kind of go like, like I have like a class, with students, and they give me like timeout, which means start to see it from the back. Okay, so what?
We get a napkin flag.
No bells are going to ring.
No bells are going to ring. Yeah, that's the problem.
Don't have another class later.
Okay, so use up the prime market, go to the subprime market. Okay, the subprime market are borrowers who don't have whose history suggests that they're going to have a higher probability of defaulting on the mortgages than people with the prime. Okay, so this is just sort of, like the prime market as a percent, booms. Okay, so again, I want to get across this point. Like the securitization was huge, the boom in housing was huge, and the movement into subprime was also quite big. Okay. So the other thing that happened with the movement into subprime is that the nature of the mortgage contracts changed a lot. Okay? So what do I mean by that? Okay, so when you look at like the prime conventional mortgage, okay, so this is like what I have, okay, and probably what most of you have. Okay, you sort of have, it's a fixed rate mortgage. There's some floating rate mortgages. You have to put down 20-25%, and sort of that even if the housing price falls a lot, the probability of defaulting is very small. Okay. When you go to the subprime market, okay, what you get are much more sophisticated mortgages, which might be exactly the opposite of what you might think, in terms of the human capital of the subprime borrower and the prime borrower, given income differences in education and all that. So what you see here is that fixed rate mortgages, 9% of the subprime market, 70%, okay, of the conventional market. Okay, when you have these hybrids, okay, what you have there are these 30-year ARMs, or you have balloon payments. Okay, so these are the low documentation loans where you have, very low payments for a year or two, and then the payments jump up after that. A lot of this was really focused on sort of the subprime and sort of the middle ground, the Alt A, and not the prime conventional loans. Okay. Okay. And then you see the delinquency rates kind of really skyrocket in subprime. So why so bad? Okay, so the subprime is not that big. Okay, so somebody asked me, this is this thing. Okay, so you have June 2008. You have the total value of sort of residential housing. It's about, let's make it 20 trillion. It's an easier number. You've got 8.7 is equity. Okay, the majority is prime, and then you get the subprime at the top. Okay, so how is like the world coming to an end? If the subprime market got messed up, right? It's like, as one of my students asked me, he said, look, if somebody had just, bombed all of the subprime houses, I'm not suggesting this, of course, would we be in this disaster? But the point being is that, this is just not that big. How could this be so big? Okay? So one thing is that it's not just the subprime market. Okay, so here sort of these are these graphs. I don't know if you've seen them, and again, I don't be particularly if you enjoyed the evening at the bar, you may not want to spend too much time on the graphs. But the point here is that see the subprime. This is kind of delinquency rates, and you can see that the delinquency rates. These are in later years. They're going up very fast. So the point here is that 10 months after a mortgage. Okay, 10 months after you sign your mortgage, for those that did this in 2007, you're already up to, 13% of the people are delinquent on their mortgages. Okay, this is like extraordinary. Okay, now what you see here in the prime market, this is the point I want to get across, is that, these rates are fairly low, but there's really a jump in how fast people are starting to default on their mortgages even within the context of prime borrowers. Okay, so one argument about why is it so big if it's only in the subprime market is it's not only the subprime market. Okay, the other issue is that many of the entities that were very exposed to the subprime market are, what I would argue are really, they're kind of pivotal in everything that goes on in the economy. Okay, so banks and investment banks were very exposed. They obviously got clobbered. You've been reading about that. Pension funds, mutual funds, foundations as well. Okay, I mean these issues have all been hurt. Okay, as this happens, people start to lose their jobs. Okay, people are going to feel this even more going down the road in coming years as pension funds, are unable to fulfill their obligations. I mean, this problem is really going to keep cascading. And the future tax obligations are kind of mind-boggling. The other thing that happened is that, this kind of goes back to the credit rating agencies. Finance is basically a set of contracts. I give you money, I evaluate your creditworthiness, or I have somebody else evaluate your creditworthiness. You go out and do stuff, and then you pay me back. Okay? If this whole system gets information that, hey, all those entities out there, banks, investment banks, credit rating agencies, those experts that were supposed to figure out who deserves society savings and who doesn't, they didn't know what they were doing. Okay, and again, I'm exaggerating, but once you increase the level of uncertainty in terms of the ability of the system to pick those most likely to be successful, okay, that permeates everything. Okay, and this is one of the reasons why when you look at the returns on short-term treasuries, they're basically zero. Okay, and the world woke up really during the summer of 2008 and said, we're kind of giving all of our savings to these institutions. Their prime function is to figure out who has the best probability of using those savings wisely. And what we're learning is they don't do this too well. Okay? And so therefore, we're going to invest in U.S. Treasury securities. I don't care if I get no return. Like zero return. It's not negative return. Okay? So this has huge then implications. People who want to start businesses, entrepreneurs. Okay? And it permeates everything. And so you see businesses that are perfectly healthy who won't be able to roll over their loans. They won't be able to meet payroll. They may have fantastic innovations that are going to improve people's lives. And because of this fear, that may not occur. Okay? The other things is that banks are very levered. Okay? And so, capital asset ratio. So if I have, 10% capital and then assets, then it only means that a 10% hit to assets will wipe out all of my capital. Okay? So it doesn't take a large percentage hit to assets to make a bank bankrupt, given leverage ratios like this. Okay, so when you have a hit to assets that might not be gigantic in terms of the assets, that can have a dramatic implications for how the bank behaves. Okay? That's sort of okay? If I'm a bank, I have like, the 100 billion in assets and I have 10 billion in equity, my assets go down by 10 billion, it says, oh, your assets only went down 10%. But now my bank is bankrupt. Okay? And that also then changes my incentives as an owner, because now I own something, I'm running something that's worthless. Okay, and you may behave differently. Okay. So all of these things are sort of cascades. Now, so what to do? So, there'll be a lot of disagreements. But in terms of broad goals, we want financial institutions, whether they're banks, investment banks, although there are not too many of those left anymore, credit rating agencies. We want these things to operate with sound incentives. Okay, so what I mean by sound incentives, I mean you have owners and uninsured debt holders who are exposed to risk. And that's going to affect their behavior in all sorts of ways. Okay. And then this other issue is a regulatory system that focuses on creating these incentives, not on adhering blindly to rules that may or may not apply as the system evolves. Okay. Now, we can talk about this. Innovation in finance, I would argue, is very important. And one of my fears is that the regulatory response is not going to be toward a regulatory system that adapts, but a regulatory system that's so onerous that it kind of stops the financial system's ability to innovate. So if we go back to the securitization, we want innovation so that Wilma can borrow to get a house. Okay, but we also want regulations that are going to not allow that, innovation to spiral out of control. Okay, so immediate goals. So save the system, not individuals. Okay? Now, what I see happening, okay, is the government saving the individuals, not the system. Okay? So by the system, I mean a set of institutions with sound incentives to go out there and find people and entrepreneurs with the best ideas and the best promise. Okay? Not people with the most accumulated wealth and political connections. Okay? Okay. Now, and this is to be disagreements. Letting the financial system go through some sort of legal bankruptcy, I think would be catastrophic. Okay? And therefore, I think that the government should use taxpayers' money to create financial institutions with sound incentives. Now, saving the system means, in my view, allowing the owners and uninsured debt holders to take a major hit. Okay? It's their businesses. These bad investments are not necessarily their fault. It could be bad luck. But that's the way it goes.
Why do you think it would be catastrophic for the bank? Or why won't the bankruptcy process work? Does this work for some other airlines go bankrupt? They come out, they're viable. Why won't it work?
Yeah, so I think I think that because I think it would take it's this issue of speed and keeping the concern going. Okay, so I'm not a bankruptcy expert, so maybe. So let me tell you let me sort of tell you some of the issues, and then maybe you know better whether this would fit within the context of bankruptcy. So the concern that I have is that if what happens is you sell off bits and pieces of financial institutions, and sort of while they didn't do a very good job, they do a reasonably good job in many areas of acquiring information about a whole assortment of individuals and businesses. And if this thing crumbles and you lose that information, by the time you get institutions to arise and kind of produce the services that they're providing and acquire the information about the firms that they're servicing, you could see many more layoffs. And that's what sort of I mean by catastrophic. Now, this doesn't mean that some institutions might not fail, but sort of, and if one could call it a bankruptcy that allowed existing institutions to sort of remain whole, wipe out equity holders, convert some uninsured debt into equity, so there's been these debt for equity swaps. If one might call that going through bankruptcy, then I guess I'm not against the bankruptcy. It's sort of allowing this thing to sort of fall apart bit by bit with so many institutions in trouble that if I were the one making the decisions, that would be a gamble I would be unwilling to take. Scandinavia did something different. So Scandinavia did something that, what Scandinavia essentially did was they nationalized the banks and then privatized them. Okay, which is very similar to, which is similar to what other countries that have experienced bankruptcies ultimately end up doing and can be very successful. So I'm not nationalization. So So the way, let me just take a step back. So okay, it's unbelievably incompetent what happened in the United States from 2007 and 2008. So you had the problem, remember, way back when in 2007, when things kind of started to get bad. Then they sort of calmed down. Okay? Basically what the government said is it's a liquidity problem. A liquidity problem for the banks means that I'm a bank and I have these assets. And then I owe some people money. Okay? My assets may be great, much bigger than my liabilities. I'm going to answer your question. Just may take me a little long to get there. So the liability holders may come and say, we want our money now. And my assets, which may be worth a lot, so I go, I can't sell them now. Okay? And the liability holders say, look, if you don't sell them right now, we're going to bankrupt you. You know, because your legal obligation to me is you got to pay me right now. But there's no market for this stuff because it's like Sunday. You know, I'm making something up ridiculous. So this is sort of be a liquidity issue. So what the government did in 2007 said, that's the problem. Okay? So the natural solution to that, and this has worked great, is that the central bank comes and it says, we'll pay you back because you want your money. And then later on, over time, when you sell off some of your assets, you pay back the central bank. And so that means that this bank, which is in great shape, very healthy, does not go through bankruptcy simply because you can't wait till Monday. Okay? And that's the way it treated the problem. Now, it was not 100% clear that this was a liquidity problem. Okay? And so a solvency problem is different. A solvency problem is I have assets, and they're kind of crappy. Okay? And the assets are worth less than the liabilities. So I'm bust. Okay? And then you come and you want your money back because, you know, you're sort of like, well, I'm kind of nervous about your solvency. Okay? And then the Fed comes and it says, okay, we'll give you your money back, and then the bank, you pay the Fed back. Now, at some point, the solvency problem is going to come to the fore. Now, the solvency problem is fundamentally different because now the incentives for the bank change dramatically. Okay, so you can think of think of myself. I'm running a bank. Okay, it's a great bank. Do you want your money back? Okay, I'll borrow a little bit from the Fed now. I'll pay back the Fed later. I'll go on with my business, and I'll go out and try to find the best people. Okay, life just goes on. Great. However, if the assets are less than the liabilities, if I'm bust, okay, and this is exactly what happened in the savings and loan crisis, my incentives change dramatically. Okay, because now it's like, okay, I get to run this bank for a little while. Eventually, they're going to close me down. Okay, which means I have to do one of a couple of things. One is I have to extract as much from this institution as I can before the government realizes that it's bust. Okay? Legally. I'm not going to break any laws. Okay? Two, I have to lobby the government so that they don't take me over for as long as possible so I can keep extracting as much as I can. Okay? And so a solvency problem is fundamentally different, okay, because it affects whether the people with the best ideas and all that kind of stuff get the money. Okay? So nationalization, in some sense, means that so the thing that was criminal is that, okay, so you deal with it like a liquidity problem. Somewhere, December 2007, February 2008, things are kind of calm. You'd think somebody at the Treasury, the Fed, these are people I know. I mean, not at the Treasury, a lot of people at the Fed. Somebody who said, you know what? What happens if it's a solvency problem? What are we going to do then? Okay? And the plan was, let's give Paulson $700 billion and he'll figure it out. I mean, that's like unbelievable that this would happen in this country. I mean, there are like lots and lots of examples of financial crises. The fact that there was no plan is unbelievable. It is literally, from the outside, unbelievable that this occurred like that. Okay, but then there is, okay, what do countries do? One thing is you could let it go through bankruptcy. Countries tend not to kind of follow that. The other is you nationalize. You say, okay, this bank is bankrupt. So you do with it what you might do in bankruptcy, except you have the government do it quickly. The government comes in, it takes ownership of it, kind of wipe out the equity holders. You have the uninsured debt holders, not the depositors. They take some hit. The exact amount is uncertain in different countries. Okay, the government maybe takes off bad assets, puts in good money, and then goes to the market and sells it. Okay, now this is sort of when I talk about saving the incentives, the people whose job it was to oversee the bank. In that context, uninsured debt holders and equity holders, they lose on their investment. Okay? The people who buy the bank going forward know that if they either face bad luck or they make some bad decisions, that's on their shoulders. You minimize the impact on the economy by not closing the bank down perhaps in a disorderly fashion, and kind of things can move on. The taxpayers take a hit. Okay? The taxpayers are going to take a hit anyway. Okay. So this would be sort of the nationalization scheme. Sorry,
Is there a difference between allowing individuals that make bad investments to take losses concerning mortgages where they were manipulated to take a bad investment? Are you making a distinction between people who were taken advantage of to take out bad mortgages?
So here what I'm thinking about is, this is a good point. Here with the perspective I'm taking, and one could certainly disagree and criticize this. In fact, there's a funny thing on Jon Stewart this week with Gwen Ifill. I'm viewing this from the perspective of saving the bank, saving the bankers. And so the point I'm having here is that you might allow the equity holders and some of the uninsured debt holders in banks to take a hit, regardless of whether it was bad luck or whether they were involved in the mortgages part or whatever, just because that's the way it goes in business. The other approach, and this is it's the flip side, would be to focus directly on all the mortgage holders and kind of renegotiating those mortgages. From what I understand, this is there are sort of there's huge complications in that. There's like a few banks and there's a lot of mortgage holders, and if you favor these mortgage holders, do you do that at the expense of the person who didn't buy a house because she was wise in looking at the mortgage and knowing that she couldn't pay back? And the other problem is that the mortgages have been broken apart. And so who has the legal authority to renegotiate? There are a variety of questions, which is one of the advantages of having the government buy up a lot of these securities so that they might be able to put back some of the mortgages and renegotiate. But that's a good point.
Do you have a sense of how much, in respect to the bankruptcy of the banks, how much of their liabilities are uninsured by the government? And in other words, how does that ratio compare to their assets?
A lot is insured now. Okay, so most of the deposits, and even the deposits over $250,000, it's hard to see the government letting those go bust. And what has transpired also over the last, since the Fed started insuring many of the liabilities on the bank's balance sheet, many of those are insured by the Fed. So the banks were having trouble raising money, and the Fed basically insured many of the securities that they were issuing.
Because in industrial bankruptcy, the liabilities, the holders of the liabilities are the ones that suffer for, as the assets are revalued, basically. And often the ratio is such that the liability holders end up with something for their money. Because the institution at a revalued basis is still got something left over.
Absolutely.
It still has assets, I guess.
Sure.
So if the bank's assets to the uninsured and equity liabilities of the bank, if you would the bank still be solvent, or is it
I think right now, if you value, right now I think there's a broad consensus that for at least almost all the major banks, that if you value their assets at some sort of a market price, And that's difficult because not all it's not like the assets are simple to value because there's a high degree of heterogeneity, that the assets, are going to be less than the non-equity liabilities.
That's what I was going to ask, isn't it becoming a function of liquidity?
The two are
basically saying that we can't value these things because they're not trading.
Yes.
And so is your solution then that if the government takes them, you can then get time?
So this is, so I think it's becoming, so the issue, tell me if some of the, just to rephrase it a little bit, some of these assets are related to the mortgage-backed securities. Okay, but every bundle is not the same. And so, is this bundle worth only 20 cents of what it was worth? I don't know. This bundle is really, really complicated, and it depends upon whether you can trade it or not after you buy it. So it's related to sort of this notion of liquidity. Its value, like how much I value this thing, depends upon whether I can sell it after I buy it. So there's this notion of liquidity. Plus, 3 weeks ago, a bundle sold for 20 cents on the dollar. I have a bundle that's called a mortgage-backed security also, or collateralized debt obligation, whatever. Should it also be valued at 20 cents on the dollar? It's not exactly the same bundle. And so the banks have a very valid argument that we don't know exactly what the value is. If the economy turned around, if the market was more liquid, the price of this would rise. Okay? This is not an unreasonable argument. The problem is that this argument's been going on now for over a year. And the price is still sort of like down there. And my concern has to do with this problem of incentives. So that if you have an owner of something, okay, and he or she sees that this thing is essentially bankrupt, the incentives for running the bank change dramatically, to getting stuff out quickly as opposed to having a longer term horizon. And this has implications for the economy as a whole, which then is going to affect the value of those things. So you have the government has faced this choice in terms of, okay, do we sort of deal with this as a solvency problem? Do we deal with it as a liquidity problem and hope that the solvency problem gets better? Okay, and they've primarily chosen the latter. And I think the growing assessment is that these things are sort of bankrupt and we have to deal with it as a solvency issue. So, I don't, what? Okay.
Is it the banks, because we're also covering other people, obviously we're covering insurance, which is related to the banks, but are we just trying to save the banking system here?
So, not necessarily, but I can only kind of think about it. My focus has been on kind of banks. They're the biggest of the financial institutions, but they're not the only ones. So, the banks are the biggest of the financial institutions. Other entities are going to have problems as well. Given experiences around the world, so if we take the savings and loan crisis in the US, which was much smaller, what happens there is that the regulators go to Congress and they say there's a $100 billion hole in the savings and loan industry, which sounds small, but at the time was sort of a big number. Congress basically said, I can't deal with that. It's too big of a number. What we will do, quite literally, very explicitly, is we will change the rules such that we no longer define the banks as insolvent. Okay? And so what do the banks do? They issue profits, knowing that at some point, because they're $100 billion in the hole, they will go bankrupt. Within a very short period of time, given the incentives that are at play, the hole in the banking system doubles to $200 billion. When politically, it then becomes advantageous to deal with the problem. Okay? This is in Japan. Okay? Same thing. They had, actually at that time, they had like $1 trillion hole in the banking system. Politically, they could not deal with this problem. It's too big. We're not going to deal with it. We will change the rules. In the middle of Japan's banking crisis, the banks are issuing dividends because the laws were changed such that, no, they're not insolvent. They're making profits. Okay? And they had a crisis, basically a slump that went on for a decade. Now, one of the advantages that the U.S. has over Japan, besides being able to look at Japan, is it's a much more competitive political system. Okay, through this period, Japan essentially had one party. Okay, so you can't say, like, those guys messed up. Whether it's really that those guys messed up or not, at least you can say those guys messed up, and then we can kind of change. It's much harder to say, like, oh, man, we caused this $1 trillion hole in the banking system, and then we're going to change. You know, one might apply that to other mistakes as well. So that's why I think there's sort of some reason to feel more optimistic. That there will be a dramatic change from the Paulson plan, which is, so the Paulson plan is getting close to about the worst you can do. The Paulson plan is basically saying, we are going to write a check to the equity holders. We'll buy stock in these things. We will do this in direct proportion to how badly you messed up. Okay, again, I'm exaggerating a little bit, but unfortunately not a whole lot. Okay, so the Paulson plan is, and so I'm hoping that there will be a change in the direction. Please.
What did you think of Jon Stewart's idea? Which was to give, money directly to the mortgage holders, I believe, bypass the banks, and then the mortgage holders would, the mortgagee or
Yeah.
pay back the bank because they'd have money in their hands, and then the banks would flourish because their mortgages would be paid.
So I think that the problem, it's a good plan, and I like the fact that it goes to some people that were probably taken advantage of. I think the problem is that this crisis has spread really far because of this informational issue, because businesses are now in trouble for not necessarily any fault of their own, and so I think we're not going to sort of get there from here. And that we know how. I mean, the world has done this before. The U.S. has done this twice before, in the last 100 years, is kind of deal with a banking crisis. So I think we can resolve this better than the other route. So this is actually sort of when, there was the speculators in the, with the Revolutionary War, where the government promised to pay the soldiers, and then those were, bought up on like 20 cents on the dollar. And then Hamilton comes and says, well, we're going to pay $1 on the dollar to establish U.S. credibility. Madison and Jefferson are so upset because it's not necessarily the soldiers who are going to get it. But they did it, in order to and so I understand where Jon Stewart's coming from, but I'll kind of stick with Hamilton on this one. Yeah.
I was wondering, it seems like it's a really important issue of where this $700 billion is coming from. And to me, it seems that that's one of the main points of contention of the debate. People that just don't really see how we can spend $700 billion on these fat cat bandits or whatever.
Or you're going to spend $2 trillion.
So are
Forget
we
the
borrowing
$700
more
billion.
money, or are we printing money? Where is this coming from?
It's not clear where it will come from. A lot of it is printing money. If you go to, you can see this, if you go to the Fed balance sheet, so if you look at like what's on the Fed's assets and the Fed's liabilities, the change in the last year is unbelievable. It's been a great time actually to teach financial institution, my class. But the Fed, which typically bought Treasury securities, is now buying the kind of securities from banks and all sorts of things, and it has expanded money supply dramatically. So the potential for inflation is there. The problem with a recession, the potential for deflation is there as well. And then some is going to come from taxes as well.
Why don't we take a couple more questions?
Okay. Yeah.
I thought initially Paulson's plan was to buy the toxic assets.
Yep.
And then he changed it
Yep.
to buy equity in the banks. And I know that initially there were some economists, and I'm thinking of Krugman specifically from the New York Times, who was adamant that you should not buy the toxic assets, that you need to put equity in. And now it seems like, I'm not really sure where, it seems like that obviously the equity plan didn't work. So are you saying that you should have bought the toxic assets? Is that what you're thinking should have happened? Or?
Yeah, I guess I'm a little bit, my main concern is there are a variety of mechanisms to get there. But the main issue is this issue of establishing the incentives. Incentives matter a lot in finance, and they matter a lot really quickly. So having these major banks operate, and it's mostly the really big banks, in a situation in which the people running them recognize that they're insolvent, is horrible for the rest of the economy. So the reason why I don't like writing the equity is it's not an effective way, a very effective way of changing the incentives, because it keeps the same people in place.
Which is why they took all those huge bonuses.
That's what I was.
This is why they took all the huge bonuses. Now with the toxic assets, there were lots of questions of, well, how do we value the toxic assets? I'm much less concerned about that. So, I'm not sure that there should be a huge choice. You'd say, okay, well, my own view would be, you say, what's the lowest possible price that the government can say the assets are worth? Let's say they're 20 cents on the dollar. I don't know. We'll say we'll give you $1 for every dollar you give us. The difference between the dollar and the 20 cents, we, the government, will take as equity. That way, if it turns out that the banks are solvent, the government will have a little bit of equity, and the banks will be clean. Given the best assessments of the banks that I've read, what this will mean is that basically the equity holders will be wiped out, but you'll very quickly create a well-capitalized bank. So you go to the bank, you say, okay, you go to the bank and you say, how much is, what's the book value of that asset? $1? How much can you get for it in the market? The bank will say 50 cents. You look around, you say, no, can't get 50 cents. You're going to take 20 cents on the dollar for it. You give the bank $1, okay? You take the assets. The difference, the 80 cents, becomes the government's equity in the bank. And you create clean banks quickly. Okay, one more. You choose. I don't know. Yeah.
Do you think Geithner's the right man for the job? You didn't hold back on Paulson.
So here's my concern. So one of the major advantages that people discussed about Geithner was a continuation. Okay, which I saw as a major disadvantage of Geithner is that you want a change. So the hope that I have is that U.S. institutions historically have adapted. Obviously, the U.S. screws up a lot on big things throughout its history. However, the country has tended to adapt and improve and move in a positive directions. We started out, we had slavery, and there were all sorts of discrimination against women and various groups, and there's less of that. There's been an improvement. With political competition, there's sort of a hope that there's going to be a movement in a good direction towards the banking crisis. My fear is that taking the step of going and saying, we need $2 trillion to deal with the banking crisis is politically really difficult. And it might be the case that sometime down the road we're going to need even more than $2 trillion if we don't fix the banking crisis, but still coming out and saying that is not the type of thing that makes politicians' heart beat faster with anticipation. And so my concern is that what's going to happen is that the administration is going to try to impose a variety of regulations to induce the banks to do stuff, like lend to the right people. So say, okay, we're going to give you this money, but you have to lend. Okay? And I have very, very little confidence. And can you have lots of confidence in the regulatory system? I have very, very little confidence in the ability of the politicians and regulators to induce the banks to lend to the right people. I mean, that's to me is fundamentally a private market activity where the best people are sort of the banks going out and making an assessment of who's going to make the most money and profits and blah blah blah, and you want well incentivized bankers to do that. And my fear is that the Geithner and Summers are going to rely very much on their own abilities to write the rules and regulations to induce banks to behave well. And I think there's lots and lots of examples that doesn't work so well. Okay, I'll shut up.
Thank you. I know, obviously, this is